Question 1. Topic: Kentucky Insurance Code. Cancellation and non-renewal of policies. An insurer in Kentucky decides to cancel homeowners' policy due to material misrepresentation made by the insured during the application process. According to Kentucky insurance regulations, what is the minimum notice period the insurer must provide before the cancellation becomes effective? A. 10 days. B. 14 days. C. 30 days. D. 45 days. Answer: C. 30 days. Explanation: under Kentucky law, insurers must provide at least 30 days notice before cancelling a policy due to material misrepresentation. The notice must clearly state the reason for the cancellation and be sent via certified mail. Exceptions exist for non-payment of premiums where a 10-day notice is typically sufficient. Kentucky Revised Statutes RSS.20320 outlines these requirements to ensure policyholders are given adequate time to seek alternative coverage. A. 10 days. Incorrect. 10-day notice applies only to non-payment of premiums. B. 14 days. Incorrect. Kentucky law does not specify 14-day notice period for cancellations. D. 45 days. Incorrect. Kentucky requires 45 days notice for non-renewal, not cancellation. Question 2. Scenario-based. Topic: Kentucky Claims Handling Laws. Unfair Claims Settlement Practices Act. Scenario: Sarah operates small retail store in Louisville, Kentucky. After severe storm, her property suffers damage and she files claim with her commercial property insurer. Despite providing all required documentation, the insurer delays processing her claim for over 60 days without valid justification. Additionally, the insurer offers Sarah settlement significantly lower than the actual repair costs. Which of the following actions by the insurer would be considered violation of Kentucky's Unfair Claims Settlement Practices Act? A. Failing to communicate with Sarah within 15 days of receiving the claim. B. Delaying claim investigation for more than 45 days without providing written explanation. C. Offering settlement that does not account for the actual cost of repairs. D. All of the above. Answer: D. All of the above. Explanation: the Unfair Claims Settlement Practices Act RAS.12230 prohibits insurers from engaging in unfair claim practices such as failing to communicate within reasonable time, typically within 15 days, delaying claim investigations without valid justification or written explanation, offering settlements that are unfair or below the actual repair costs. In this scenario, the insurer violated several provisions of the law by delaying the claim without explanation and offering an unfair settlement. Kentucky law mandates that insurers act in good faith and conduct timely and fair claim settlements. Failure to comply can result in penalties and legal action. Question 3. Topic: Unfair trade practices and consumer protection. Misrepresentation and false advertising. Which of the following scenarios would be classified as misrepresentation under Kentucky's Unfair Trade Practices Act? A. An insurance producer inflates the benefits of life insurance policy to entice client to buy. B. An insurer publishes policy brochure with minor typographical errors. C. Policyholder submits false claim after an accident. D. An agent accidentally provides incorrect contact information for the claims department. Answer: A. An insurance producer inflates the benefits of a life insurance policy to entice a client to buy. Explanation: under the Unfair Trade Practices at RSS.12010, misrepresentation occurs when an insurance producer makes false, misleading, or deceptive statements about an insurance policy's terms, conditions, or benefits to induce sale. Misrepresentation is a serious violation that can result in license suspension, fines, or other disciplinary actions. B. An insurer publishes policy brochure with minor typographical errors. Incorrect. Minor typographical errors are not considered misrepresentation. C. Policyholder submits false claim after an accident. Incorrect. This is insurance fraud, not misrepresentation. D. An agent accidentally provides incorrect contact information for the claims department. Incorrect. This would be classified as negligence, not misrepresentation. Question 4. Topic: Kentucky insurance laws and regulations. Role and authority of the DOI. Which of the following actions is within the authority of the Kentucky Department of Insurance? DOI: issuing fines and penalties to licensed insurance agents for failure to maintain required continuing education. C. Credits. B. Adjusting insurance policy rates based on market trends. C. Determining the cancellation of policies based on the insured's driving record. D. Setting premium rates for commercial auto insurance policies. Answer A. Issuing fines and penalties to licensed insurance agents for failure to maintain required continuing education. C. Credits. Explanation. The Kentucky Department of Insurance, DOI, is responsible for overseeing the licensing and regulation of insurance professionals. This includes enforcing C requirements for insurance producers and imposing fines or penalties for non-compliance as outlined in KRS 304.9.330. The DOI has authority to ensure that licensees meet the required C standards for renewal. B. Adjusting insurance policy rates based on market trends. Incorrect. Insurance rate setting is generally done by insurers, though the DOI oversees their compliance with regulations. C. Determining the cancellation of policies based on the insured's driving record. Incorrect. While the DOI regulates the cancellation process, decisions based on driving records are made by insurers within the framework of the law. D. Setting premium rates for commercial auto insurance policies. Incorrect. Premium rates are established by the insurance companies, although they must file these rates with the DOI for review and approval. Question 5. Topic: Kentucky-specific insurance regulations. Health and life insurance. Which of the following statements regarding Kentucky's health insurance regulations is true? A. Health insurance policies in Kentucky must provide coverage for pre-existing conditions if the insured has had continuous coverage without break. B. Kentucky mandates that all health insurance policies must cover the full cost of prescription medications. C. Kentucky prohibits insurers from charging higher premiums for individuals with pre-existing conditions under all circumstances. D. Health insurance policies in Kentucky are required to offer coverage for essential health benefits as defined under federal law. Answer. D. Health insurance policies in Kentucky are required to offer coverage for essential health benefits as defined under federal law. Explanation. Kentucky health insurance regulations comply with the Affordable Care Act, which mandates that health insurance policies cover essential health benefits. These include services like emergency care, hospitalization, maternity care, and prescription drugs. This is part of federal law and is enforced by the Kentucky DOI. Health insurance policies in Kentucky must provide coverage for pre-existing conditions if the insured has had continuous coverage without a break. Incorrect. This only applies under certain conditions, such as when transitioning between employers or certain types of policies. B. Kentucky mandates that all health insurance policies must cover the full cost of prescription medications. Incorrect. Kentucky regulations do not mandate full coverage for prescription medications, though some plans may offer substantial coverage. C. Kentucky prohibits insurers from charging higher premiums for individuals with pre-existing conditions under all circumstances. Incorrect. Insurers cannot charge higher premiums based on pre-existing conditions for policies under the ACA, but may in some limited circumstances for non-ACA compliant plans. Question 6. Scenario-based. Topic: Kentucky Insurance Fraud Prevention Act. Scenario: Mr. Thompson is an insurance agent in Kentucky. He receives a commission for signing up a new client. However, in order to increase his commission, he misrepresents certain benefits of the policy to the client, including exaggerating coverage limits and not disclosing exclusions. The client purchases the policy but later discovers the discrepancies. What violation of Kentucky law has Mr. Thompson committed? A. Insurance fraud for misrepresenting the policy benefits. B. A violation of the insurance producer's duty to offer legally compliant contract. C. Violation of the Unfair Claims Settlement Practices Act. D. Violation of the requirement to keep accurate records of sales. Answer A. Insurance fraud for misrepresenting the policy benefits. Explanation. Mr. Thompson has committed insurance fraud under the Kentucky Insurance Fraud Prevention Act RIS.47010 by misrepresenting the policy's benefits and coverage limits. Insurance fraud includes intentionally providing false information to induce policyholder to enter into contract. The exaggerated statements to the client led to financial gain for Mr. Thompson, making it fraudulent act. B. Violation of the insurance producer's duty to offer legally compliant contract. Incorrect. While agents must ensure contracts are compliant, if specific action is classified as fraud due to the misrepresentation of coverage details. C. Violation of the Unfair Claims Settlement Practices Act. Incorrect. This act pertains to unfair claim settlements, not to the sale of insurance policies. D. Violation of the requirement to keep accurate records of sales. Incorrect. There is no indication that Mr. Thompson failed to maintain proper sales records in this scenario. Question 7. Topic: Kentucky-specific insurance regulations. Property and casualty insurance. Which of the following is not required coverage under Kentucky's automobile insurance law? A. Personal injury protection (PIP). B. Bodily injury liability. C. Uninsured motorist coverage. D. Collision coverage. Answer D. Collision coverage. Explanation: Kentucky's automobile insurance law mandates specific coverages including personal injury protection (PIP), bodily injury liability, and uninsured motorist coverage. However, collision coverage is not mandatory in Kentucky. Collision coverage is optional and provides protection for the insured's own vehicle in the event of an accident. A. Personal injury protection (PIP). Incorrect. PIP is required by Kentucky law to provide medical and lost wages benefits to injured parties, regardless of fault. B. Bodily injury liability. Incorrect. Bodily injury liability is required by Kentucky law to cover injuries to others caused by the insured. C. Uninsured motorist coverage. Incorrect. Coverage is required in Kentucky and protects against damages caused by an uninsured driver. Question 8. Topic: Kentucky Insurance Code. Legal insurance contract. Which of the following elements is not necessary for legal insurance contract in Kentucky? A. Offer and acceptance. B. Legal capacity of the parties involved. C. Specified premium amount for the coverage. D. Insurable interest of the policyholder. Answer C. The specified premium amount for the coverage. Explanation: Under Kentucky law, a legal insurance contract requires 4 basic elements: offer and acceptance, mutual agreement between insurer and insured; legal capacity, both parties must have the mental capacity and legal authority to contract; insurable interest, the policyholder must have a legitimate interest in the insured property or life. The specified premium amount is not a required element to form a valid contract, as premiums can be adjusted based on risk assessment. A. Offer and acceptance. Incorrect. This is an essential element of the valid insurance contract. B. Legal capacity of the parties involved. Incorrect. All parties must have the legal ability to enter into the contract. D. Insurable interest of the policyholder. Incorrect. Insurable interest is required to ensure that the policyholder would suffer a financial loss due to the insured event. Question 9. Topic: Kentucky claims handling laws. Third-party claims handling. Which of the following is true regarding third-party claims handling in Kentucky? A. The insurer is required to handle third-party claims in the same manner as first-party claims. B. Insurers are not obligated to pay claims made by third parties unless the insured specifically authorizes it. C. The insurer must notify the third party of its claims decision within 30 days of receiving the claim. D. Third-party claims are exempt from the Unfair Claims Settlement Practices Act. Answer A. The insurer is required to handle third-party claims in the same manner as first-party claims. Explanation: In Kentucky, insurers are required to treat third-party claims made by someone other than the policyholder, such as an injured party in an accident, in the same manner as first-party claims. The insurer must conduct an investigation, assess damages, and make a decision based on the evidence, providing prompt responses to all parties involved. B. Insurers are not obligated to pay claims made by third parties unless the insured specifically authorizes it. Incorrect. Third-party claims may be paid even without the insured's explicit authorization if the claim is valid and covered by the policy. C. The insurer must notify the third party of its claims decision within 30 days of receiving the claim. Incorrect. There is no specific 30-day notice requirement for third-party claims. It is the same as for first-party claims. D. Third-party claims are exempt from the Unfair Claims Settlement Practices Act. Incorrect. Third-party claims are covered by the Unfair Claims Settlement Practices Act, which applies to both first-party and third-party claims. Question 10. Topic: Kentucky Property Insurance Regulations. Fire insurance. Which of the following is true regarding fire insurance policies in Kentucky? A. Fire insurance policies in Kentucky must cover both the structure and the contents of the insured property by default. B. Kentucky law requires fire insurance policies to provide coverage for smoke damage, even if not explicitly stated in the policy. C. Fire insurance policies in Kentucky can be cancelled by the insurer for non-payment only if the insured has missed 2 consecutive premium payments. D. The Kentucky Insurance Department does not regulate fire insurance coverage limits. Answer B. Kentucky law requires fire insurance policies to provide coverage for smoke damage, even if not explicitly stated in the policy. Explanation: Under Kentucky law, fire insurance policies are required to cover smoke damage caused by fire, even if it's not explicitly listed in the policy. This requirement ensures that the insured receives compensation for damages resulting from smoke exposure. A. Fire insurance policies in Kentucky must cover both the structure and the contents of the insured property by default. Incorrect. Policies generally cover the structure, but coverage for contents is optional unless specified. C. Fire insurance policies in Kentucky can be cancelled by the insurer for non-payment only if the insured has missed 2 consecutive premium payments. Incorrect. Insurers can cancel policies for non-payment after single missed payment following proper notice. D. The Kentucky Insurance Department does not regulate fire insurance coverage limits. Incorrect. The Kentucky Insurance Department regulates the coverage limits for various types of insurance, including fire insurance. Question 11. Topic: Kentucky Life Insurance Regulations. Beneficiaries. Which of the following is required by Kentucky law regarding life insurance beneficiaries? A. The beneficiary must be family member or relative of the policyholder. B. The beneficiary must be named in writing by the policyholder. C. Life insurance policy cannot have multiple beneficiaries. D. Beneficiaries must be U.S. citizen or resident to receive the death benefit. Answer: B. The beneficiary must be named in writing by the policyholder. Explanation: under Kentucky law, life insurance policies require the policyholder to name the beneficiary in writing, typically on the application or a designated form. This ensures clarity in the event of a claim. The beneficiary must be a family member or relative of the policyholder. Incorrect. Beneficiaries can be anyone chosen by the policyholder, not limited to family members. C. A life insurance policy cannot have multiple beneficiaries. Incorrect. Kentucky law allows for multiple beneficiaries, with the policyholder designating how the benefits will be distributed. D. Beneficiaries must be a U.S. citizen or resident to receive the death benefit. Incorrect. There is no restriction on the citizenship or residency of beneficiaries, though legal requirements may differ by insurer. Question 12. Topic: Kentucky auto insurance. Minimum coverage requirements. Which of the following is true regarding Kentucky's minimum auto insurance requirements? A. The minimum required liability coverage is $100,000 per person for bodily injury. B. Kentucky law mandates that all drivers have uninsured motorist coverage. C. Kentucky requires that drivers carry at least $50,000 in property damage coverage. D. Kentucky's mandatory auto insurance laws only apply to vehicles used for business purposes. Answer: C. Kentucky requires that drivers carry at least $50,000 in property damage coverage. Explanation: in Kentucky, the minimum required property damage liability coverage is $50,000, which applies to damage caused to another person's property in an accident. A. The minimum required liability coverage is $100,000 per person for bodily injury. Incorrect. The minimum required bodily injury coverage is $25,000 per person. B. Kentucky law mandates that all drivers have uninsured motorist coverage. Incorrect. Coverage is optional in Kentucky, though it is highly recommended. D. Kentucky's mandatory auto insurance laws only apply to vehicles used for business purposes. Incorrect. The insurance requirements apply to all vehicles operated on public roads, regardless of use. Question 13. Scenario-based. Topic: Kentucky Insurance Code. Claims handling scenario. Ms. Jackson was involved in car accident and submitted claim to her auto insurance company. The insurer failed to respond to her claim within the required time frame. After 40 days, she still had not received decision on her claim. Which action is the insurer in violation of under Kentucky law? A. Failing to provide settlement offer within 30 days. B. Failing to conduct fair claims investigation. C. Failing to provide written denial notice within 15 days. D. Failing to settle the claim in good faith. Answer A. Failing to provide a settlement offer within 30 days. Explanation: under Kentucky law, insurers are required to respond to claims within 30 days with either an acceptance or a settlement offer. Failure to do so is a violation of the Unfair Claims Settlement Practices Act. B. Failing to conduct a fair claims investigation. Incorrect. While insurers are required to investigate claims fairly, this option doesn't address the timeline for claims response. C. Failing to provide written denial notice within 15 days. Incorrect. The written denial must be provided within 45 days, not 15 days. D. Failing to settle the claim in good faith. Incorrect. While insurers are required to settle claims in good faith, the violation in this case is tied to the failure to meet the 30-day requirement for response. Question 14. Topic: Kentucky Health Insurance. Mandates and consumer protections. Which of the following is required under Kentucky's health insurance consumer protection laws? A. Health insurance policies must cover all pre-existing conditions with no waiting periods. B. Health insurers must offer coverage for mental health conditions and substance abuse treatment. C. Health insurance policies must cover experimental treatments if prescribed by doctor. D. Health insurers are prohibited from excluding coverage for maternity and newborn care. Answer: B. Health insurers must offer coverage for mental health conditions and substance abuse treatment. Explanation: Kentucky law, in line with the Affordable Care Act (ACAT), mandates that health insurers cover mental health conditions and substance abuse treatments as part of essential health benefits. Health insurance policies must cover all pre-existing conditions with no waiting periods. Incorrect. Under the ACAT, pre-existing conditions cannot be excluded, but certain types of policies may have waiting periods for certain conditions. C. Health insurance policies must cover experimental treatments if prescribed by a doctor. Incorrect. Experimental treatments are not always covered, and this decision typically depends on the policy terms. D. Health insurers are prohibited from excluding coverage for maternity and newborn care. Incorrect. Although the ACA requires coverage for maternity and newborn care, Kentucky insurers may have some flexibility in the types of plans they offer. Question 15. Topic: Kentucky insurance regulations. Unfair practices. Which of the following is considered an unfair practice under Kentucky insurance law? A. Offering discounts for safe driving records. B. Providing insurance coverage for insureds with history of prior claims. C. Offering settlement that is lower than the actual claim amount, knowing the insured will accept it. D. Charging higher premiums for more comprehensive coverage. Answer: C. Offering a settlement that is lower than the actual claim amount, knowing the insured will accept it. Explanation: offering a settlement that is knowingly lower than the actual claim amount, especially when the insurer knows the insured is likely to accept it, is considered an unfair practice under Kentucky law. This violates the Unfair Claims Settlement Practices Act. A. Offering discounts for safe driving records. Incorrect. Offering discounts based on safe driving records is a fair practice and is common in the insurance industry. B. Providing insurance coverage for insureds with a history of prior claims. Incorrect. Insuring individuals with a history of claims is not an unfair practice. However, premiums may be higher due to the risk. D. Charging higher premiums for more comprehensive coverage. Incorrect. Charging higher premiums for more comprehensive coverages is standard practice. Question 16. Topic: Kentucky Insurance Code. Consumer rights. Which of the following rights does consumer have under Kentucky's insurance laws? A. The right to cancel any insurance policy without penalty within the first 10 days of purchase. B. The right to automatically receive refund for unused premiums if policy is cancelled before its expiration. C. The right to grace period for missed premium payments under all circumstances. D. The right to request review of the insurer's claims decision by the Kentucky Insurance Department. Answer: D. The right to request a review of the insurer's claims decision by the Kentucky Insurance Department. Explanation: under Kentucky law, consumers have the right to request a review of the insurer's decision regarding claim. If the insurer denies or disputes the claim, the consumer can file complaint with the Kentucky Department of Insurance for further review. A. The right to cancel any insurance policy without penalty within the first 10 days of purchase. Incorrect. While free look period exists for life insurance, the specific timeline can vary and is not always 10 days for all types of policies. B. The right to automatically receive refund for unused premiums if policy is cancelled before its expiration. Incorrect. Refunds depend on the specific policy terms and the reason for cancellation. C. The right to grace period for missed premium payments under all circumstances. Incorrect. While some policies include grace period, it's not guaranteed under all circumstances, such as in cases of fraud or non-payment. Question 17. Topic: Kentucky life insurance. Replacement of policies. Which of the following must be disclosed to the policyholder when replacing an existing life insurance policy with new one in Kentucky? A. The cash value of the new policy is guaranteed to be equal to the old policy's cash value. B. The cost of the new policy will always be higher than the existing policy. C. The policyholder's right to receive the first premium as refund within 10 days. D. The advantages and disadvantages of replacing the existing policy. Answer: D. The advantages and disadvantages of replacing the existing policy. Explanation: Kentucky law requires that agents disclose the advantages and disadvantages of replacing an existing life insurance policy. This ensures the policyholder can make an informed decision about whether replacement is in their best interest. The cash value of the new policy is guaranteed to be equal to the old policy's cash value. Incorrect. The cash value may differ and should be assessed based on the policy terms. B. The cost of the new policy will always be higher than the existing policy. Incorrect. The cost can vary depending on the type and amount of coverage, and it's not guaranteed to be higher. C. The policyholder's right to receive the first premium as refund within 10 days. Incorrect. The free look period applies to life insurance policies, but the specific time frame can vary by policy type. Question 18. Topic: Kentucky property insurance. Homeowners insurance. Which of the following is not typically covered under standard homeowners insurance policy in Kentucky? A. Damage from fire and lightning. B. Personal property loss due to theft. C. Water damage caused by burst pipe. D. Damage from earthquakes. Answer D. Damage from earthquakes. Explanation. A standard homeowners insurance policy typically does not cover earthquake damage. Separate earthquake insurance would be required. Other types of damage, such as fire, theft, and burst pipes, are usually covered under a standard policy. Question 19. Topic: Kentucky health insurance. Coverage for pre-existing conditions. Which of the following is true regarding coverage for pre-existing conditions in Kentucky? A. Health insurance policies can exclude coverage for pre-existing conditions for up to 12 months. B. Health insurance policies must cover all pre-existing conditions, regardless of the waiting period. C. Kentucky insurance regulations allow health insurers to impose 6-month waiting period for pre-existing conditions. D. Health insurers are not allowed to impose any exclusions for pre-existing conditions after the policy has been in effect for 6 months. Answer A. Health insurance policies can exclude coverage for pre-existing conditions for up to 12 months. Explanation. Under Kentucky law, as part of the Affordable Care Act account requirements, health insurers can exclude coverage for pre-existing conditions for up to 12 months, depending on the type of plan. However, after this period, coverage must be provided. Question 20. Topic: Kentucky auto insurance. Uninsured motorist coverage. Which of the following is required under Kentucky's auto insurance laws? A. All drivers must carry uninsured motorist coverage, but only for bodily injury. B. All drivers must carry uninsured motorist coverage for both property damage and bodily injury. C. Uninsured motorist coverage is optional and can be waived in Kentucky. D. Uninsured motorist coverage must only be offered by the insurer and is not mandatory for the policyholder. Answer C. Uninsured motorist coverage is optional and can be waived in Kentucky. Explanation. In Kentucky, uninsured motorist coverage is optional. Drivers are required to be offered this coverage, but have the option to waive it if they choose. Question 21, scenario-based. Topic: Kentucky insurance fraud laws. Mr. Johnson files a claim for damages from a car accident, but the insurer notices discrepancies in his report and suspects insurance fraud. Under Kentucky law, what is the next step the insurer should take? A. Deny the claim and immediately report the fraud to the police. B. Investigate the discrepancies and report the findings to the Kentucky Department of Insurance. C. Pay the claim in full, as the insurer cannot deny claims based on suspicion alone. D. Inform Mr. Johnson that the claim is under investigation, but take no further action until more evidence is gathered. Answer B. Investigate the discrepancies and report the findings to the Kentucky Department of Insurance. Explanation. When an insurer suspects insurance fraud, they are required to investigate the discrepancies and, if necessary, report their findings to the Kentucky Department of Insurance. This ensures that fraudulent claims are properly handled. Question 22. Topic: Kentucky life insurance. Contestability period. How long is the contestability period for life insurance policies in Kentucky? A. 6 months. B. 1 year. C. 2 years. D. 3 years. Answer C. 2 years. Explanation. In Kentucky, life insurance policies typically have a contestability period of 2 years. During this period, the insurer could investigate and potentially deny a claim for misrepresentation or fraud in the application. Question 23. Topic: Kentucky workers' compensation. Employer obligations. Which of the following is requirement for employers in Kentucky regarding workers' compensation insurance? A. Employers are required to provide workers' compensation insurance only for employees involved in hazardous work. B. Employers must provide workers' compensation insurance for all employees who work 30 or more hours per week. C. Employers are required to provide workers' compensation insurance for full-time employees only. D. Employers are exempt from providing workers' compensation insurance if the business has fewer than 10 employees. Answer: B. Employers must provide workers' compensation insurance for all employees who work 30 or more hours per week. Explanation: Kentucky law mandates that employers provide workers' compensation insurance for employees who work 30 or more hours per week, regardless of whether the work is hazardous. Employers with fewer than 10 employees can apply for exemptions under certain conditions. Question 24. Topic: Kentucky property insurance. Policy cancellation. Which of the following is valid reason for an insurer to cancel property insurance policy in Kentucky within the first 60 days? A. Non-payment of premiums. B. The insured filed claim in the first 30 days. C. The insured fails to maintain the insured property. D. The insured changed the type of property covered under the policy. Answer: A. Non-payment of premiums. Explanation: In Kentucky, insurers can cancel a property insurance policy within the first 60 days for reasons such as non-payment of premiums. The insurer must give proper notice to the policyholder. Question 25. Topic: Kentucky insurance licensing. Continuing education. How many hours of continuing education C are required for licensed insurance agent in Kentucky to maintain their license? A. 8 hours every year. B. 12 hours every 2 years. C. 16 hours every 3 years. D. 24 hours every 4 years. Answer: B. 12 hours every 2 years. Explanation: Licensed insurance agents in Kentucky are required to complete 12 hours of continuing education C every 2 years to maintain their license. Question 26. Topic: Kentucky commercial insurance. General liability. Which of the following is typically excluded from coverage under general liability insurance policy in Kentucky? A. Property damage caused by the insured's operations. B. Bodily injury caused by the insured's products. C. Injuries that occur while the insured is driving company vehicle. D. Damage to the insured's own property. Answer: D. Damage to the insured's own property. Explanation: A general liability insurance policy typically does not cover damage to the insured's own property. It covers third-party claims for bodily injury, property damage, and other liabilities that occur due to the insured's actions or products. Question 27. Topic: Kentucky Insurance Code. Fraudulent claims. What is the penalty for committing insurance fraud in Kentucky? A. Fine of up to $1,000. B. Fine of up to $5,000 and or imprisonment for up to 2 years. C. Fine of up to $10,000 and or imprisonment for up to 5 years. D. Fine of up to $20,000 and or imprisonment for up to 10 years. Answer: B. A fine of up to $5,000 and or imprisonment for up to 2 years. Explanation: Kentucky law imposes penalties for committing insurance fraud, including a fine of up to $5,000 and or imprisonment for up to 2 years. The severity of the penalty can depend on the amount of fraud involved. Question 28. Topic: Kentucky auto insurance. Minimum liability limits. What is the minimum liability coverage required under Kentucky's auto insurance law? A. $15,000 per person for bodily injury and $30,000 per accident for bodily injury. B. $25,000 per person for bodily injury and $50,000 per accident for bodily injury. C. $50,000 per person for bodily injury and $100,000 per accident for bodily injury. D. $100,000 per person for bodily injury and $300,000 per accident for bodily injury. Answer: B. $25,000 per person for bodily injury and $50,000 per accident for bodily injury. Explanation: The minimum liability coverage required under Kentucky law is $25,000 per person for bodily injury and $50,000 per accident for bodily injury. These are the required minimums for auto liability insurance. Question 29. Topic: Kentucky life insurance. Policyholder rights. Which of the following is right of policyholder under Kentucky life insurance regulations? A. The right to cancel the policy for any reason during the first 60 days and receive full premium refund. B. The right to change beneficiaries without written consent from the original beneficiary. C. The right to request grace period of 45 days for late premium payment. D. The right to waive the contestability period in the first 2 years. Answer: A. The right to cancel the policy for any reason during the first 60 days and receive a full premium refund. Explanation: Kentucky law gives policyholders the right to cancel a life insurance policy within the first 60 days and receive a full premium refund. This is known as the free look period. Other options listed may have restrictions or conditions. Question 30. Topic: Kentucky property insurance. Flood insurance. Which of the following statements is true about flood insurance in Kentucky? A. Flood insurance is typically included in standard homeowners insurance policy in Kentucky. B. Flood insurance is required by law for all property owners in Kentucky. C. Flood insurance is available through the National Flood Insurance Program (NFIP), but not private insurers. D. Flood insurance is only available for homes located in flood-prone areas in Kentucky. Answer: C. Flood insurance is available through the National Flood Insurance Program (NFIP), but not private insurers. Explanation: in Kentucky, flood insurance is typically not included in a standard homeowners policy, and it can be purchased through the National Flood Insurance Program (NFIP). Some private insurers may offer additional coverage, but the NFIP is the primary source. Flood insurance is not legally required for all properties, though it is strongly recommended for homes in flood-prone areas.